WTI crude oil fell into familiar lows on Friday, driven down by geopolitical fears washing out on hostage negotiations and sparks of doubt that OPEC will successfully underproduce pumping growth in the non-OPEC sphere. Qatar is heading up efforts to negotiate a ceasefire in Gaza, if at least temporarily to allow the exchange of hostages, and Qatar's steady success in talking down both sides of the conflict is seeing crude oil flounder as geopolitical tensions ease. The situation in the Red Sea isn't expected to lead to a long-term rearrangement of oil flows, but it's also difficult to see a resolution of the conflict in the near term. Instead, there's a significant risk of more disruptions, particularly after the Houthi strike on a tanker carrying Russian fuel late last month. The OPEC is set to see a long-term challenge this year as it tries desperately to undercut global non-OPEC production, imposing stiff production quotas on member nations as non-OPEC producers such as the US outstrip OPEC pumping caps. Analysts are increasingly concerned that the US and other non-OPEC producers could entirely oversupply global markets, and investors will be keeping a close eye on inventories in 2024. Ongoing worries regarding China's economic recovery have continued to weigh on the oil market. The International Monetary Fund's projection of a slowdown in China's economic expansion to 4.6% in 2024, with further deceleration expected in the medium term, prompts concerns about future oil demand in one of the world's largest economies. This aspect remains a pivotal factor influencing trends in the global oil market. The strong employment numbers in the United States have resulted in a bolstered dollar, influencing the global demand for crude oil. This suggests that the likelihood of sustained high interest rates, with the potential to dampen economic growth and, consequently, the demand for oil, remains significant in major economies such as the United States and the Eurozone. In contrast, the U.S. oil rig count remains stable, indicating a steady future supply outlook. Meanwhile, the slide in oil futures resulted in a slowdown in drilling activity, with an expected delay of around 5 months, reflecting the time taken to finish drilling wells currently underway and for short-term contracts to expire. In the upcoming week, the oil market is poised for a bearish trend, influenced by several key factors. Strong U.S. economic data reduces the likelihood of near-term interest rate cuts, potentially dampening global oil demand amidst a stronger dollar. Geopolitical stability in the Middle East, particularly regarding Israel and Hamas, could lower risk premiums in oil prices. OPEC+'s decision to maintain current output levels and China's economic slowdown, as forecasted by the IMF, are expected to further suppress demand. Additionally, the stabilized supply situation, with a steady U.S. oil rig count, suggests adequate supply, contributing to the downward pressure on oil prices. From a weekly technical perspective, the oil price plunge occurred when sellers crossed to the weak side of the 200-day moving average at $74. This level is new resistance. A sustained move under the 50-day moving average could lead to a quick test of the main support at the $70 level. Meanwhile, a further escalation in the U.S.-Iran conflict may pose a significant risk of oil supply disruptions. If this occurs, we could witness a swift price reversal, testing the $78 resistance at the 50-day moving average. Thank you for watching. Please don't forget to support the channel if you enjoyed the video. See you in the next one.